Welcome to a Market Insight Call, where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me this month, as always, is Chris Ahrens. There's a lot of noise to go through this month. What are we covering today?
A lot of noise, and we've made a lot of changes in the strategies too to talk about. So we really laid it out last month. We really put together an outline of what we were looking for in the market. So I figured we could start there. And really started with a change in leadership. We talked about how tech rally had started to lose momentum last month, and we were looking for new sectors, industrials, small caps, mid caps too. We've been making those changes. You've seen them in the portfolios. That's been working well.
So the check mark on getting that one right.
Yes. We also talked about earnings recovery. We thought earnings would surprise to the upside. They did. They beat the analyst expectations, pretty close to our expectations, but the whisper numbers, what people were actually expecting above analyst expectations, that did not happen. So there
some little check mark.
Little check mark. So there was a recovery, but the reaction to it was not bullish, which is what we thought would happen. There was a lot of reasons for that. Could be weakness out of China, treasury issuances. There were some downgrades in the banks. There's a lot going on. We'll hit those, and then we'll close out with some FOMC projections. So it really starts out with closing earnings season. We're still about a little over 90% of companies have reported pretty good results. We're expecting about down 6 in the red box up top. We're tracking for about down 3.8. We said it would be down about 3. So a little bit below our expectations. There were some good results for certain stocks in our strategies, Alphabet, Amazon, Visa. They looked really good, really good. And then Apple and Microsoft, not so good. That's 13% of the index. So
right.
if they're not surprising to the upside, it's going to be hard to keep the rally going. So really, we didn't quite get what we were expecting, and a lot of that was probably also doing with expectations. When we look at the bottom chart, that is revisions of where they're expecting earnings to go a year from now. And the down revisions were a little bit higher than expected.
So would it be fair to say that expectations were a little bit above on the earnings report, but what changed was more guidance or what they think going forward, which is probably why we've seen some dampening of the bullish news, right? Because it's always looking forward. They're not so much concerned about the current earnings. They were a little bit better, but then guidance goes down.
A great example of that is energy. So the reason we're seeing down earnings, down almost 4%, energy earnings were down over 50%. Now, if you look at a screener, which we'll show here in a second, energy is actually the top performing sector the last month. And the way we measure it on a relative strength basis, energy is ranked number 1. Worst earnings and still ranked number 1. So just like you said, just looking at what happened in earnings is not enough to get a full picture. But we can look at the change in leadership here as well. It's energy. There's materials, industrials that are also beating the S&P 500. And the lowest ranked, which is down 6% the last month, is technology. So we're seeing that change in leadership in the very short term. Actually, yesterday, 8:15, we added commodities to the signal strategy.
Haven't had that in a while. It's kind of odd that we're doing it because we have all this inflation's coming down. At the same time, we're seeing signals to say go ahead and buy some commodities.
Right.
And to your point on this chart, this isn't what we would have been reviewing last month, right? This is almost the exact opposite to your point on that change of leadership. We've seen a little bit of down movement in the market. When did that start?
That's just been the last couple weeks. So we pulled the candlestick chart just the last month. Now we've pulled these a lot of the times. The candle just means if it's green, you opened on the low side and you closed on the high side, and the wicks are the
daily movement.
Daily movement, right? And the red's the exact opposite: opened high, closed low. Now these are weeklies, so really trying to remove some of that noise and just look at what happened week over week, looking back the last month, draw a line right across the middle of the screen. Not much has happened on the month. So if you're not checking accounts, you won't notice a difference the last month. But like you said, in the short term, there was movement, a pretty orderly 3% rally up, 3% move down.
And what initiated that move down, or what was the headline that really seemed to drive it?
There was treasury issuance, treasury downgrades, and a lot of bad news out of China.
Right. This, one of our favorite slides, because we've been above trend. So if you look at that, the channel or the spot between those blue lines, this is really what the S&P is trending. And you can actually think of your capital market expectations whenever you're looking at your e-money plan with your advisor. And oftentimes this slope will be about 5 to 6%. And that's what we're looking at. So when we get ahead of that or above this channel, That's time not to call a top or try to time the market, but we know we're getting good valuations, so we could fill cash hubs, we can rebalance. And we talked about that last month of getting above this, especially with the correction and the withdrawals that we've had to be making from the cash account. It was a good time to make some changes. You want to talk about those changes, Chris?
It's the exact changes we made. We talked about rebalancing. The signal strategy, there were over 150 accounts that had drift from the rally up, too much drift, too large equity exposure. We rebalanced that last week, brought it back within tolerance. So we said it would have been great to have a little rally, couple percent pullback. We got it in before some of the volatility the last couple days. So we did get really good prices on the rebalance. So we made that change. We also talked about, well, we'll probably raise hub accounts. Well, now we're doing that. Hub accounts were down to about 12 months if you already took your August distribution, which really would only get you through a little bit of next year, right? We increased that target to 18 months. That's going to give us clarity around the end of this hiking cycle for the Fed. And also, we won't have to take a distribution from accounts if we don't want to, and we'll be able to get through the election of next year as well.
That's the big thing. If we were at 12 months, you're basically looking right at the tail end of the campaigns. I'm sure it's not whether there will be volatility, and a lot of times it's just the uncertainty of it as to the downside. Now, before people hear that we're becoming bearish or making changes to our bullish thing, our target is typically 24 months. So we expect to see the market continuing to be in its upward trend. We hope to continue to build that up because we would rather be at 24 months. We're just having to refill these hubs and get them back up to that level after a lot of volatility and a lot of correction within the market. Now that we're getting to gains and getting back to highs, it's time to take some of that risk off.
When we're drawing down on cash hubs, say down around 6 months or so, we really want to save that for times when the market's in a drawdown.
Right.
And well, like you said, the market's up. It makes sense to start pulling from it. There are a lot of bearish headlines coming in the short term. We have poor seasonality. Earnings did not lead to a strong recovery. We talked a lot about yield curve and credit last month. PEs are a little bit elevated. I think you have a good story from your management team that you meet with.
So we were at Vistage, which is a group of CEOs, and I sit down at my table after a conversation with you going back and forth about some things that we're trying to understand. What's the bear argument? And one of the bear arguments was just sitting down because there's 5 different articles that the chair is presenting for all these CEOs to read, and every single one of them is about a recession. What to do if we're having a recession? Are we going to have a recession? I would say this is the most telegraphed recession that has not yet happened. And that in and of itself could cause a recession, right? If there's a lot of CEOs that are feeling the concern, reading these headlines, there could be a self-fulfilling prophecy there. It could also be used as a contrarian that we've already priced it in because of so much uncertainty. So we wouldn't want to make investment decisions on that, but we're definitely paying attention to a lot of the bear arguments that are out there.
And when we're talking about cash hubs, historically we're talking about low yielding securities. Cash is becoming an asset class again. Right. The holdings in our cash alternative strategies are paying above 5% yields from the holdings. Now there's cash drag in the strategies because we have to liquidate them to then send the cash out. But the actual holdings themselves are paying above 5% yields. And
just to demonstrate how important that number is a lot of times when we're modeling out what returns you'll get, 5% is close to what a lot of people are expecting to get overall their 60-40 or a 70-30 allocation. So to see cash being able to generate that now, it doesn't mean it's going to do it year after year, right? It's just the next year that you're going to pay on that. But it's definitely an area that you want to have more exposure to than whenever it was 0%.
Yeah, that's a good point. Let's go through a couple of those points that we were just talking about. So seasonality, we are now actually entering a weak time for the market. August is historically not as strong as some other months, and September is the worst month for the market. If we look at the chart here, it's down about on average 1.1% on the month, while all the other months are largely positive with the exception of a couple small months. September is the only month that actually has more down months than up months when you look back, going back to the late 20s. So we are entering this pattern where there is seasonal patterns where the market does tend to be weak.
But once again, we're already taking, because of our process, we're already taking actions to help mitigate some of those risks and extend it out 18 months.
It's something because it's not a certainty, of course, you're not going to trade it in your long-term strategies. Right. But if we were to say that there's common sell-offs in September, and now hub accounts are down to 9 months or so. Once we get past there, we want to refill those back to 18 months, like we already said, get us through 2024. And that really gets us to Treasury. They were downgraded by Fitch the beginning of August. We pulled here, we pulled on the right is looking at the largest credit ratings from S&P, Moody's, and Fitch. Moody's still holding on to that AAA. Well, S&P downgraded to AA plus back in 2011, and now Fitch is catching up and saying, no, AA plus makes sense.
Right, and it was not good to be the CEO 6 months after that downgrade. I don't think it's going to be the same with Fitch. S&P, oddly, though I would agree with their call long term, they were way early. We actually had a significant rally in Treasuries after the downgrade. I think Fitch is taking more of they're probably a better time at this point, because whenever we look at the math, there are certainly concerns there, and we're starting to see that in issuance. You want to talk about issuance?
Yeah, large issuance out of Treasury. They announced this really right at similar time of getting their downgrade, $103 billion in issuance. I just pulled headlines just to keep it really simple. On the left, we have the 3 and the 10-year. They were both actually absorbed pretty well. Came in very relatively close to yields that were being expected. It was the 30-year issuance that rates increased a little bit. There wasn't as much demand. That can be common, kind of called the segmented market theory, where there's not a lot of people that go out and buy 30-year treasuries. Last year, 30-year treasuries were down over 30%. So it's not really a space that we're buying a lot of 30-year treasuries either. Right. We will buy 3 to 10-year treasuries if yields are elevated enough. So you can see how there would be a lot stronger demand for securities like that.
Yeah, basically anyone that's buying those are probably matching it to a liability. If you're a pension, you're saying, well, 30 years we're going to have this much in benefits to pay out. Let's just buy a bond, and we don't have to worry about it.
Yeah, then you're down 30%, but you
don't
okay
care,
with it. Yeah,
right? You're just earning more on your yield.
Of it. Right, and with rates rising, it's becoming a problem for Treasury what they have to pay out.
And this is where I'm talking about on Fitch being good on timing. If we look at just how the debt of the country is, it's been what I've been calling a mother of all arms. I mean, it's mainly short-term paper. And that was great a couple of years ago when you're paying less than 1% on a $30 trillion deficit or debt. Now, because that paper matures quickly and interest rates are high, we're seeing a sharp uptick. And if we get 3 to 4%, that's going to be pretty problematic, because the debt on 30 trillion is over $1 trillion. If it's 3 or 4%, yes, you're looking at $1 trillion of tax revenue that has to go out automatically, and it's after Social Security, also goes out Medicare. At some point in the very near future, if we're not there already, all of the mandatory spending that goes out by law, spending that Congress doesn't have any discretion on, is already consuming all the revenue they're going to bring in. So that means those discretionary, with military spending being the biggest one, there's going to be some type of cut that would be necessary, or what's more likely, and why we continue to favor equities long term, is you're going to have to inflate your way out of this situation. So they were going to continue to keep interest rates down. And I think that's the most likely, because the political will to default on some of this debt to make it go away just isn't going to be there. And you can't raise tax revenue high enough to cover it. One, the math wouldn't work, and two, you would see a contraction in GDP, so it would defeat its purpose. You'd probably end up with less revenue. So I think Fitch is right to downgrade on the concern. I don't think it's ever going to be a case where you're not going to get money back that is owed. The question is, what's the purchasing power of that?
That's a good point. All this is putting short-term pressure on rates. So rates have been moving higher. We know when rates move higher, it is negative for equity sentiment at least, and you do get small sell-offs in equities when that happens. So it does make a lot of sense. It's when we talked about before, past few months, when there's a little bit too much froth in the market. If this were happening and a strong rally in equities was happening at the same time, you'd say this may not make sense.
Right.
So it does make sense to see equities come down a little bit. And just to close out the point of downgrades, Moody's, which did not downgrade Treasury, put either downgrade, negative reviews, or negative outlooks for 25 banks, and really put in a top. Once they released this, banks had a hard time catching back. The rally started selling off a few percent as well.
And a lot of this, I think, has to do with the yield curve that we've talked about. Or we didn't really mention too much about it as one of our bearish indicators. We still see that inverted yield curve, which is very problematic for banks whenever they're trying to loan, and they're receiving less interest than what they're having to pay on a dollar. So it makes sense that we're seeing these downgrades considering the current environment, which is a little problematic. It's a fair argument within the economy.
We had problems back in March with banks, regional banks. A lot of those were regional or smaller banks that made their negative outlook. They're basically saying the problems we had in March may not be done. Right. And there are a lot of people that agree with that. That's a headline and an actual problem that we may run into over the next 6 months. Really brings us to our last point on our outline, which was the FOMC. They don't have an official meeting in August. They meet in September, but they do have an economic symposium up at Jackson Hole. They've been doing this for over 30 years. And we remember last year there was fireworks when this happened. On the right-hand side, Powell came out and he spoke hard against inflation. Inflation was a lot bigger problem then. Right now, we've seen the trailing numbers at 3%. It was a lot more problematic at the time. He wanted to make sure equity returns were not getting overheated and making kind of that wealth effect as well on stocks and increasing inflation. He talked down stocks over 3% in one day, and the 7-day reaction was over 7%. Don't think that's going to happen again, but of course, if there's something that they wanted to do something as well, we know they have done this historically.
Yeah, it's definitely a significant event that you want to pay attention to. The dad and me can't resist the dad joke of the slide where the central bankers think highly of themselves. And so highly, whenever we're looking at financial organizations, we've yet to get an invite. I would really like to be at Jackson Hole, and if Chair Powell is listening, please send us our invite. We will pay our own way. I think they've made the media pay their own way.
Media has to pay their own way to cover the cost for everyone else, is what the article said, which was straight out of the Kansas City Fed. And the topic is structural shifts in the global economy. So don't really know what that's going to mean. Again, to what could be bearish is the structural shift. Short-term rates need to be higher to fight inflation. That's something that could be, or is it something more labor-related that could be the shift in the economy? We'll probably talk about that next month.
I think if the previous year was to talk the market down, I think there's more likely a case that they're going to try to talk the market up here. I'm hoping that they come out and say something about, we're done with interest rate raises.
Right.
We'll see.
In the market on interest rate raises, they're only expecting one more through the end of the year. So that's right now the target range is 5.25 to 5.5. So we can see in the bottom about 30% probabilities what the market's placing on one more increase through the end of the year. So like you said, I think we're almost to the point where the hiking cycle is behind us.
And for those that are evaluating my crystal ball, I said we wouldn't get any more rate hikes. I've been wrong. I still stand by that. I don't think they're necessary at this point. And I envision that they'll probably be lower in a year from now, but my crystal ball is as clear as mud, so we'll find out.
I agree. That's all I had.
All right, well, I hope you enjoyed this call. We always look forward to you joining. If you have some friends that would be interested, hit that share button, send it over, and while you're down there, hit that subscribe button. And if you enjoyed my new purple jacket, please hit that like button as well. Thanks, we'll see you again next month.